thank you all for coming to this speaker event. Today, we are honored to have with us Evan Katz. Evan is the managing director of Benoni Capital, a leading Manhattan-based alternative asset investment firm that forms, grows, hold interests in,
Yeah,
and
very
raises
comfortable too.
very
Yeah.
substantial investor capital for compelling hedge funds,
Right.
private equity funds, and other alternative investment funds. And
Unbelievable.
in three recent annual Hedge Week awards, in the 2021 to 2023, Evan was voted and nominated by the hedge fund industry as its best fundraiser.
Evan was also an honors graduate of the Wharton School of Business and Harvard Law School, and he's been working on Wall Street since 2003. He is a highly regarded expert on alternative asset best practices, institutional investors, family offices, and successful large-scale fundraising. In this regard, he has raised very substantial investor capital and commitments for compelling hedge funds, private equity funds, and early-stage technology and medical life sciences companies. So we all thank you very much, Evan, for being here today and for speaking with us, and we'll leave it to you to get started with the presentation.
Well, thank you. It's great to be back at Wharton, and thanks for having me. If everybody who's on Zoom can go on mute until the questions later, that'd be great. If everyone just could please go on mute. And I'm looking forward to speaking with everybody. And thanks for everyone who sent the questions in advance. And it is great to be back at Wharton. So I did list here all of my contact information, but as I say at the bottom, there's a QR code on the last slide. So if you make it to the end, you can just take a picture of the QR code and you don't have to retype everything in. I also will be distributing copies of the slides and the video after it is edited, and I'll make that available to everybody at Wharton as well. So here's the contact information, or just wait for the QR code on the last slide. Very brief background regarding yours truly. I was born on Long Island. I went to Wharton, was a finance major there. Go Quakers. Went to Harvard Law School, actually same class as Michelle Obama, small world. Spent about 20 years in hedge funds and on Wall Street. Was on the board of directors of the Hedge Fund Association for about 5 or 6 years. And as you mentioned, nominated for Best Fundraiser and got the Young Leadership Award in 2011. I'm one of the original founding members of the Wharton Hedge Fund Network in New York, and it is great to be back at Wharton. So we're going to talk a little bit about the state of the hedge fund industry and a lot of best practices and answer a lot of questions. They were fantastic questions. Thank you to everyone who submitted them in advance. So the hedge fund industry right now is about $5 trillion. And the $5 trillion obviously are mostly institutional investors. And they are looking to some of the best and brightest hedge fund managers to try to get them good returns, good risk-adjusted returns, and to be stewards of their capital. As reflected in several of the questions, sort of the current hottest strategy, as a lot of people asked about, is private credit and lending. There's been a lot of disintermediation of the banks, and a lot of hedge and private equity funds are now getting into private credit and private lending, both because of opportunities and also because the banks have been getting increasingly regulated about their activities, and there's a lot of great opportunities there. But as I say in the slide, just a bit of a warning, when things get a bit too hot and frothy, whether it's private credit, the tulips, the dot-com bubble, the subprime bubble, you might want to be a little bit careful. In other words, there's some great private lending, great private credit opportunities, but not everything that is private credit is going to work out well. There's an old expression on Wall Street: when everybody gets very excited about a stock or a strategy and starts piling in, including your barber, it may have become a bit too frothy. So that is the latest and greatest strategy, but obviously, as with every investment, look carefully, regardless of the strategy. State of the industry continues. One thing I always mention is smaller managers tend to outperform, and they still continue to do so, often by 100 to 300 basis points per year. This has been a trend that's been going on since I've started out in the industry about 20 years ago. And yet the larger managers have roughly about 85, 90% of the assets, in spite of smaller managers tending to perform better. And obviously there's exceptions in every direction. There are some horrible small managers and phenomenal big managers. But on average, about 200 basis point difference. But as they say in the slide, there's an old expression, nobody ever got fired for buying IBM. Ask your parents about that one. So most allocators, especially the big ones, continue to pile into the larger managers, and it can be very tough getting started as a smaller manager. And some of the questions we'll get to later discuss this as well. There's been a lot going on. We'll get into some of this later in terms of regulatory changes. The Fifth Circuit recently struck down some SEC rules that would have limited hedge funds' ability to give certain preferential information to some investors versus giving them to all investors. And those regulations were recently struck down, and the SEC decided not to appeal. That was a big change or averted change in the industry. So we're going to get into a little bit about some Hedge Fund 101 and probably Hedge Fund 202 and Hedge Fund 303. First, some of the basics. What is a hedge fund? Who started the first hedge fund? And in what year did he do so? So with no further ado, it was a little bit more than 75 years ago. I was shocked it's been that long. 1949, Alfred Winslow Jones, or A.W. Jones, largely, pretty much universally credited with being the first hedge fund manager, created a so-called hedge fund. He traded stocks. He was long short equity, meaning, as you know, he would go long stocks he thought were going to go up, and he would short sell stocks he thought were going to go down, and he added leverage on top of it. And his goal was to make money regardless of which way the markets move, or at least to lose less money when the markets go down, and to be less correlated, especially to down markets. And I was shocked when I did realize it was 75, almost a bit more than 75 years ago. Traditional answer until most recently, what are hedge funds? Now, a lot of the strategies on the slide. I've spoken to some of you before the event, but briefly, long short equity still number one by far, the most common hedge fund strategy. But there are many, many others. There's activist investing, algorithmic or quantitative or systematic strategies, convertible arbitrage, fixed income, global macro, where rather than predicting typically single stocks, they try to predict global macro movements and what's going to go up or down in which countries, in what sectors, a much more 10,000-foot view, if you will. There's managed futures with CTAs and CPOs. There are some hedge funds that try to be market neutral, where they have very low returns, but very stable returns, and they take all the beta out of the market. There's merger arb funds. There's sector funds like biotechnology and technology. And there's also stat arb and vol arb funds. One thing I'll mention briefly about sector funds, there are some large institutional investors that will not allocate to sector funds, which frankly I think makes no sense at all. If you ask them why, they'll say, well, they tend to be a bit more volatile. And of course, they're right. Biotech and technology are a single sector. And if you are just a single sector, you're going to tend to be a bit more volatile than if you're the entire market, the entire, say, S&P. But what I always say to the investors is if you typically allocate $250 million per fund, and there's some great biotech or technology funds, why don't you invest, say, $100 million with individual biotechnology and technology funds? You end up getting similar exposure, and the volatility is lessened because you only give them, say, half or a third of the allocation. And I've made that point to many investors on many occasions. And in fact, if a big allocator gives someone like Millennium $250 million, what do they think Millennium's doing with the money? They're giving $50 million to the biotech person, $50 million to the consumer person, $50 million to the technology PM, et cetera. So I think it really makes no sense not to allocate to sector funds if they're good. Maybe just give them a lesser portion of your typical allocation if volatility is that much of an issue. But that said, pretty much anything these days can be done. It is being done in a hedge fund format. I mentioned a couple of things here. Artificial intelligence, not surprisingly, was a huge number of questions addressing AI. I've only seen a couple of strictly speaking AI funds, but a lot of funds are now using artificial intelligence. I mean, just like I am now using, ChatGPT and Grok 24 times a day, a lot of hedge funds are now making an increasing amount of use of AI. Well, I've only seen a couple that are 100% AI. But hedge funds can be pretty much anything. They can be auto or credit card loans that hedge funds collateralize. They can invest in commodities, oil and gas, gold and silver, corn and wheat. There are now an increasing number of crypto funds. And nowadays, small places you might have heard of, like BlackRock and Fidelity and Goldman Sachs and JP Morgan and Morgan Stanley, either have crypto funds or have approved their investor clients to invest in crypto funds. And I'll say a bit more about crypto funds later. Uh, there's currency funds, intellectual property licensing and litigation funds, life settlement funds, where you basically buy life insurance policies you think are mispriced. There's litigation finance funds, where you fund law firms that do intellectual property or mass tort cases, uh, funds that invest in mortgages, and as I said, private credit and private lending. So the takeaway from the last two slides is basically anything that the human imagination can think of doing in terms of investments, you can probably do in a hedge fund. And I have probably seen at least a couple of dozen funds that are doing it. I've often joked that if you can find the man or woman who can pick the horses at Pimlico at the racetrack upstate, and we can get that man or woman audited, I'll raise them $1 billion to pick the horses at Pimlico. Uh, Not surprisingly, I'm still waiting for that phone call from somebody who actually has found this person who can pick the horses at the racetrack. But the point is, pretty much almost anything can be done in a hedge fund format or a private equity format, depending upon how liquid or illiquid it is. So basically, the alternative definition of a hedge fund is nowadays is pretty much anything liquid. Probably should be liquid. If it's not liquid, it should be in a private equity structure. It trades some sort of instruments on a market or over the counter, whether that's stocks, bonds, currencies. It's not a mutual fund. A mutual fund is its own type of legal entity. As you all know, hedge funds almost always charge a management fee. When I started, it was often 2%. Now it's 1.5%, or 2%. Depends on the strategy, depends on the performance, and it also depends on a little bit of negotiation. And as everybody knows here, virtually every hedge fund charges a performance fee. When I started, it was pretty much 20%. Now it's somewhere between 10, 15, and 20%. Maybe 15 is about average. But traditionally, it was 2 and 20%. But one thing I'll mention about the so-called 2 and 20 of hedge funds, it used to be a big hedge fund was a couple of $100 million. And maybe you needed the 2% on a couple $100 million to pay your people, pay the rent, and keep the lights on. But now a big hedge fund is 10, 20, $30 billion. And in fairness to the investors, it's a little bit harder to argue that you need a 2% fee on a $10 billion hedge fund to keep the lights on and pay people and to pay the rent. So a little aside about a bit of the compression of hedge fund fees. It's hard to justify 2% when you're running $10 billion unless the returns are insane, and you can get it if you put up great numbers. I mentioned in one of the bullet points that hedge funds rarely have a so-called hurdle rate, meaning the rate they've got to beat in order to get the performance fee. Most hedge funds don't have one. As you may know, most private equity and venture funds do have a hurdle rate. Basically, it's a historical difference. Not sure if it makes sense or not, but it still is pretty much the way the case is today. Hedge funds, as you know, typically take in money monthly, most of them. They get subscriptions monthly. And typically redemptions are quarterly with notice, but they could be more, they could be less. The only key thing that really needs to be emphasized about the redemptions to investors, they just better make sense with the underlying strategy. 15 years ago, when I got started in this business, 15, 20 years ago, a lot of lawyers just stamped quarterly liquidity on the hedge fund without really focusing on the nature of the underlying investment. I mean, if you're a large cap equity, obviously you can have quarterly or monthly liquidity to your investors. Big cap stocks you can sell and not move the market, unless you're a $50 billion fund, perhaps. But there's been a lot more focus post the Great Recession of 2008 and 9 to make sure that there is an alignment of the liquidity of your investments and the liquidity you give to your investors. So there's got to be that alignment to avoid a mismatch in either direction. Here is the one hedge fund cartoon from the presentation, entering Greenwich speed limit 2 and 20. This was, I actually saw this at a huge institutional investor I was meeting with at their office. I asked them if I could make a photocopy of it. As some of you may know, Greenwich, Connecticut, historically was the unofficial capital of the hedge fund industry because a lot of hedge funds went there when the state of Connecticut used to have no income tax. Those were the good days. There was no income tax. And if you were a successful hedge fund manager and did well, you did not pay state income tax. Those days are gone. Connecticut now has an income tax, but Greenwich is still either the official or unofficial home of the hedge fund industry, although frankly, there's probably more in New York City than there is in Greenwich, but the cartoon still makes sense. So what happened over the past decade with hedge funds? To put things in context, uh, you know, business history should be a required class at any business school because 99% of the time it's the same stuff happening over again. Maybe in a different envelope, maybe with a different window dressing, maybe with different icing on the cake, but the cake is the same. It's the same things people get right, the same things people get wrong for the past hundreds of years, a lot of emotion and so forth. So in 2008, 2010, as everybody knows, we had the great financial crisis, the Great Recession. Um, and so there was a lot of quantitative easing where the Fed printed a lot of money to try to stimulate the economy. There were very low interest rates, unprecedented low interest rates, the lowest anyone's seen for decades, and to try to reinvigorate the economy. And the stock market went up in almost a straight line, not quite, but you get the picture. And for probably a decade or so, hedge funds were having trouble outperforming the S&P because if you have a hedge fund and you are hedging in some manner, presumably, it's hard to outperform quantitative easing pushing the S&P up on a regular basis. In other words, how can a hedged hedge fund outperform the S&P when the S&P has easy money, interest rates are close to zero, and is basically going up at a whatever degree angle? So hedge fund fees came down because hedge funds couldn't outperform the S&P in a straight up bull market. Then came 2023. The S&P was down 19.44%. And a lot of investors realized, and a lot of business students realized for the first time, that what goes up can come down. It will come down. If you've never lived through a major bear market, yes, the S&P was down substantially, and a lot of hedge funds were either down less or up some. So, there's an old expression, how does it go? You never know who's swimming naked till the tide goes out. And in 2003 and 2008 and in March 2020, when the markets were down substantially, you then learn pretty quickly how your portfolio is doing and do you and your funds have proper risk controls in place. And we'll get to risk controls somewhat later because it's a critical thing. The thing that probably most people don't focus enough on because it's not the sexy part of it. Making money is the sexy part. Scoring the touchdowns, pick your metaphor. That's the sexy part. The risk controls, it's kind of like buying insurance on your house or your car. Everybody hates writing the checks, and unless your car gets stolen or burns down or your house burns down, you never think about it. But risk is critical. So as a result, hedge fund cartoon slide B, the entering Greenwich speed limit is actually probably now about 1.5 and 15%. That's probably about average. There's industry studies where they need to be more exact numbers, but that's probably close to it. So how are hedge funds structured? What types of entities are there, and how and where are they created? So let's dive into that. There's typically three entities for a hedge fund. There's typically the fund, ABC Hedge Fund, LP in Delaware. That is the actual fund into which investors invest their capital. There's the IM, or the investment manager, or the advisor to the fund, same thing. Typically ABC IM LLC, or some variation of that, typically also Delaware. And there's the general partner of the fund, also Delaware. I put in parentheses on the slide, why both? Why do you have a separate investment manager and a separate general partner? Long story short, it has something to do with taxation when there used to be long-term capital gains, and also sometimes just segregating things for liability purposes. But if you ask ChatGPT, why do most hedge funds typically have separate investment managers and general partners? I'm sure it'll give you a very accurate, longer answer that I won't get into here. But they're typically separate, and typically all three are Delaware. So there's the fund, the investment manager, and the general partner. The investment manager advises the fund, and the general partner is the general partner of the fund, and all the investors are the limited partners of the fund. In terms of where the fund is located, most domestic funds are located in Delaware. It has got the most robust history of law for companies and funds. So just like no one ever got fired for buying IBM, no one ever got fired for creating a company in Delaware or creating a fund in Delaware. Investors know what they're getting. Even if your fund is in Little Rock, Arkansas, do not make it a Little Rock, Arkansas fund. Investors are not going to want to bother to figure out the corporate or fund law in Arkansas. Stick to what they know, stick to Delaware. So the onshore fund is typically Delaware. The offshore fund can be Cayman, Bermuda, BVI, Ireland, Luxembourg. And basically, who invests offshore? Offshore are two types of investors. Or to put it another way, offshore investors are non-US tax-paying investors. So who does not pay tax in the US? Typically, if you are a foreign investor, if you're from Canada, Europe, Asia, South Africa, Latin America, wherever you're from, you typically don't pay US tax. If you invest in a fund, you invest in the offshore fund. In addition, US not-for-profits, ERISA funds, so endowments, foundations, pensions, 401ks, typically invest in the offshore fund. And the reason is to block UBTI. It's a tax issue. I'm not going to get into it. You can ask ChatGPT to explain what is UBTI in a hedge fund context. If you want to do that, it'll give you a long answer, but it's typically why. So basically, the non-US investors allocate to the offshore fund to avoid tax withholding. And sometimes they do so in a master feeder structure where basically the fund manager can allocate. So it makes it a bit simpler. You can Google or ask ChatGPT about master feeder structure. And sometimes at the bottom of the slide, I mentioned separately managed accounts, where instead of investing in a fund, the investor invests basically in a managed account that he, she, or it control, and the hedge fund manager advises that account. So you can set up an account at Fidelity or Schwab or any major bank or custodian, State Street, and the investor can put their 50, 100, $250 million into that, and the hedge fund advises the account but doesn't control it, but they're allowed to trade on it. One thing that was new to me when I got into the industry about 20 years or so ago is there's a lot of so-called service providers who work with a hedge fund. There's a real constellation, if you will, a real 360-degree Swiss Army knife, to mix metaphors, for folks who work with hedge funds. And it's important to know who they are because the fund hires and works with all of them. So the service providers fit into about 5 or 6 categories. There's the accounting firms that do audit and tax, the big 4, and I mentioned 4 other firms that are really solid mid-size auditing firms. They do the audit and the tax for the hedge fund. Obviously, hedge funds have to be audited or people are not going to invest in them. There's the so-called administrator. This is a independent third-party company that basically administers and oversees not the investment decisions, of course, that the manager does, but it helps with operations, reporting to investors, getting out the monthly statements, verifying that when the manager says that he or she or it were up 2% in a given month, that number is actually real. And they have access, of course, to all the trading accounts. And I mentioned 4 of the bigger, better known administrators or other ones as well. Obviously, you can't have anything to do with anything these days without attorneys for onshore and offshore attorneys. And I listed a half dozen or so of the top firms in the field. In terms of the onshore ones, there's also some great offshore attorneys as well. Obviously, you need a bank for the fund to keep its bank accounts and so forth. Also, compliance consultants. There were some compliance consultants that all they do are advise funds about compliance issues. It's a huge industry. Another bullet point I mentioned on the slide is cybersecurity. This had been a major SEC issue. Pretty amazing that the SEC, having been around for countless decades, after the boom of the internet, had to also become a cybersecurity expert. And part of their audit and review and examination of hedge funds was not only investments and not only trading and a bunch of things, but also cybersecurity. Welcome to a brave new world. There's also insurance, typically D&O and E&O. D&O is directors and officers, and E&O is errors and omissions. It's basically insurance in case something goes wrong. And most big hedge funds have insurance. And then, of course, there's the prime broker. The prime broker is typically the entity through which the hedge fund trades. Citi, Goldman, Morgan, there's a bunch of them, JP. I mean, I put in parentheses on the slide. They also have a so-called cap intro group, which also helps to raise the hedge funds more money and bring in more investors. Because obviously, the more investors, the bigger the AUM, the bigger the trades, and the prime broker makes more money. But as everybody knows on Wall Street in general, and in hedge funds in particular, do not ever rely on the cap intro team because there's 5, 10, or 20 of them, but they have several thousand clients. You need your own internal fundraiser. You can't rely on a prime broker who's got maybe 10x or 20x or 50x the number of clients per cap intro person to raise all your money. One thing I'll mention on this slide, a lot of people were asking about career advice and what if they don't have a background in hedge funds, and a lot of questions we'll get to. Many of these names on this slide publish research and what's going on in the industry. So, a lot of them, especially the law firms, publish what's going on, news, updates, white papers. And if you sign up for them, that's a great place to get started. And I've got some other references later, but I wanted to mention it. Wanted to mention it now. So now that we know types of hedge funds, types of entities, where they are, and the service providers. So who works at a hedge fund and what does each person do there? Some of this may be self-explanatory, some not. We'll go through it pretty quickly. So obviously there's the portfolio manager, one or more, the so-called PMs, the ones who are making the investment decisions. Obviously they have a team of analysts who support the investment research. Increasingly, there are quants who do coding and models, and I got a bunch of questions that we'll get to about quants and models. Increasingly, actually, not just the quant funds have quants working there. Increasingly, even the discretionary firms they may call them quants, they may call them coders, they may call them data people, but you get the idea. Very similar thing. They have a chief financial officer or CFO who's responsible for everything one could imagine, from payroll to negotiating contracts with the prime broker. Some have a chief operating officer, some have them combined. They've got typically hedge funds, accounting and trading and back office who deal with the trades and keeping track of investors and a lot of the data and the accounting and trading. Hedge funds that are bigger should have a dedicated, independent, standalone chief risk officer. When they're smaller, understandably, they may have someone who's sharing those responsibilities. And I mentioned a lot the answers to the questions about risk because that's probably one of the most underappreciated things. Everyone focuses on making a lot of money or trying to make a lot of money and putting a lot of points on the scoreboard, but risk is critical. And then most of the big hedge funds, or I should say all the big hedge funds and most of the medium-sized ones, have a general counsel because obviously when you get to a certain size, there's enough legal things going on that it pays to have somebody in-house. So is the roughly half dozen or so categories of people that are working at a hedge fund. Obviously, depending on size, you could have 5 people at a hedge fund, you could have 50, you could have 250. It depends on the size of the fund and how many different things that they do. One thing I should mention too, because I think it helps to get a good feel about the industry, and a lot of people don't know it if you've never been there, is what are a hedge fund's principal documents, constituent documents? I thought a lot of people are not too familiar. They may know a couple, but not all of them. So let's cover the primary ones. In no particular order, perhaps, there's about a half dozen or so. There's the so-called one-pager or tear sheet. This is basically the one-page summary of the hedge fund, what they do, what their track record is, perhaps who their service providers are, their performance metrics versus perhaps the S&P or a hedge fund index. Essentially, if you picture a baseball card of your favorite baseball player or basketball player, it tells you everything you need to know about him or her, how well they've done over the years, a bunch of statistics, and maybe a few sentences. That's basically what this is. I will say one thing, though. The one-pager used to be one page. A lot of them now are becoming 2-pagers. There's just so much information. And from a legal, compliance, and regulatory best practice, it's probably best to have as many disclaimers on each document standing alone as you can have. So in other words, the private placement memorandum may have 50 to 100 pages, including dozens of pages of disclaimers, and that's great. But the best practice, as the law firms will tell you, is on every document to have at least as much as you can fit in. So in the one-pager, they're typically now 2-pagers and either a page and a half of data and half a page of disclaimers, or 1 page of data and a half a page or an entire page of disclaimers. In addition to the 1 pager, there is, of course, the PowerPoint, the so-called PowerPoint or pitch book, meaning the 15, 20, 25-page document that has essentially the marketing document. The 15 or 20 pages about the team, the strategy, the fund, what they do, how they mitigate risk, the team background, and so forth. And it should be about 15 to 25 pages, no more. And there should, of course, be 1 or 2 pages of disclaimers and disclosures that cover some of the risks as well. The private placement memorandum, or PPM, to which I referred before, is the 50, 75, 100-page document that is basically the offering document, and it discusses everything under the sun about the team, the strategy, the risks, the mitigations, everything you could imagine. One could say it discusses everything that might go wrong, could go wrong. You get the picture. It's a long document prepared by the legal team and the fund PMs in collaboration with each other. Then there's the limited partnership agreement, or the LPA, which is basically the agreement between the limited partners and the fund, which discuss the nature of the relationship, the fees that are going to be paid, indemnification issues, reporting issues. It's basically the prenuptial, if you will. It's the marriage contract between the partners and covers their entire relationship. Then there's the subscription documents, or the subdocs, which investors fill out when they actually subscribe to a hedge fund and join the hedge fund. Institutional investors and family offices, discuss who they are. There's a bunch of AML and KYC, anti-money laundering, know your customer, and the investor fills out subdocs, which are somewhere probably around 10 to 12 pages with a lot of check the box. They have to certify typically they're accredited investors or qualified purchasers, where the money came from an AML and KYC standpoint, et cetera, et cetera. Then there's the investment management agreement. This is the agreement between the fund and the investment manager, where basically the fund hires the investment manager, potentially for 2% a year or 1.5% a year, to manage the assets of the fund. And then there's also often a virtual data room, which contains all of the above documents, plus copies of the fund's audited financial statements, Form ADV, Form PF. And I'm not going to get into those, but you should probably Google or ask ChatGPT, what is Form ADV? What is Form PF? It's worth knowing if you're going to be in the hedge fund industry. So what types of entities of people are the most common investors in hedge funds? Now that we've got the hedge fund set up, we have the entities created, we have the people in place, we have the documents in place. Now we're fundraising. What type of entities or people are the most common investors in hedge funds? Some of this you may know, some may be new. So hedge fund investors can be individuals. In the US, they're all going to be taxable, so they will all invest onshore, typically the Delaware entity. As I mentioned before, if they're non-US, Canada, Europe, Asia, Latin America, they're typically all offshore, for example, Cayman, in order to avoid US tax withholding. They typically have to be high net worth or richer, if you will, so-called accredited investors. So, it's an interesting situation. In the US, and I may disagree with this, in fact, I probably do, there's typically no limitations on what you can invest in. If you go to your stockbroker and you think you should own X thousand or $1 million of a certain stock, you'll typically buy that stock. And obviously the stockbroker has certain obligations to help you make wise decisions. And if he or she disagrees, you can have a conversation. But you can basically buy stocks, you can buy bonds, and so forth. But in the States, if you want to buy and become an investor in a so-called private placement, a hedge fund, a private equity fund, a venture capital fund, you've got to be an accredited investor. And I think I probably disagree with this because you should be able to invest in whatever makes the most sense for you. Although in all honesty, if you're not an accredited investor, you're probably not going to pass the minimum investment size anyway for a hedge fund, because most hedge funds, you've got to put in at least $1, $5, $10, or $20 million. So if you're not an accredited investor, you probably can't afford to invest it anyway. But legally, you have to be an accredited investor. We deal largely with huge endowments, foundations, pensions, fund of funds, so-called institutional investors. They have somewhere around $6 or $7 trillion of capital. Most of the investors we work with typically allocate somewhere between 10 and $200 million per investor per fund. We also deal with so-called family offices. This is a phrase that when I got into the industry, I had never heard of the phrase family office. And if you ask 99% of the people on the street, they'll have no idea what in the world a family office is. It just sounds very mysterious and almost a contradiction in terms. As some of you may know, a family office is basically a business that does one thing and one thing only. It only manages the money of that family. It's a captive money manager, if you will. So we have relationships with hundreds of family offices, so-called single family offices that allocate the money for one family, and so-called multi-family offices that collectively allocate the money for 1 dozen, 2 dozen, 100 families at a time. And then there's also various investor clubs. And I mentioned one club called Tiger 21, where basically it's kind of like an outsourced group that vets and looks closely at hedge funds and other investment opportunities and makes recommendations to the entire group if they should or should not invest in those. So those are a good number of sort of the individual or family investors. As I mentioned before, there's institutional investors, endowments, foundations, fund of funds, insurance companies, OCIOs or outsourced chief investment officers, pensions and seeders. Most of those are not-for-profit, hence offshore investors. The fund of funds are for-profit, and they invest onshore. So one question that sometimes people ask me is, who in the world regulates hedge funds? Or who is the regulator of hedge funds? And the answer is, it depends. So it depends on what they trade. So the majority of hedge funds, as you know, trade equities, stocks. So if a hedge fund trades equities or stocks, the U.S. Securities and Exchange Commission, or SEC, is the primary regulator of hedge funds who trade stocks. If you trade futures, not surprisingly, the Commodity Futures Trading Commission, or the CFTC, is your primary regulator. Someone might ask, why in the world are there two regulators? In the UK, for example, there's the FSA. And in most countries, or many countries, you have one regulator who regulates what I lovingly call all the financial stuff: stocks, bonds, options, futures. If we were setting this up from scratch, we would never have multiple regulators. You have one regulator who does everything: stocks, bonds, futures, options, all the financial stuff. The reason we have two, and it's a long story, I won't get into it, is historical. The CFTC got involved with grain and commodities, and there's different Senate committees that work with this, and there's two regulators. And if, as you can imagine, try convincing one regulator to give up power to join another regulator. Very difficult. It probably will never happen. So we have two distinct regulators. Okay, so what if you're a hedge fund and you're not trading securities and you're not trading futures? Who's your regulator? So, for example, what if you're trading spot currencies like the G10 currencies? Spot currency, the current US dollar versus euro, or the euro versus the Japanese yen, or the Japanese yen versus the Canadian dollar. Who's your regulator? Well, you're not trading securities. You're trading spots, so you're not trading futures. You have no regulator. And this is one of the very interesting things I discovered once. There is no regulator. Or, as I say in the third bullet point, if you and I create a hedge fund that trades rare baseball cards or rare wine, not sure it makes sense, but if it does make sense, we have no regulator because we're not trading securities and we're not trading futures. But the SEC always has anti-fraud jurisdiction. So you may not have a regulator, but you have to play, as I always say, even if you don't have a regulator, pretend that you're regulated. Do what you would always do, even if you had a regulator, for obvious reasons, but obvious to you and I, but not always obvious to everybody. So even if you're not regulated, pretend that you are. I have a couple of slides coming up now regarding hedge fund blowups and hedge fund frauds, because we can't go through several dozen slides on all the good and all the money everybody's hopefully making without discussing the other side of the coin, blowups and frauds. And the interesting thing, the sad but interesting thing, is that the blowups and the frauds are rarely very complicated things. It's always simple, stupid stuff. So we'll talk about the blowups first, then we'll get to hedge fund frauds. So I say there's two kinds of hedge fund blowups. And I don't mean losing a little money. I mean really losing a lot of money. I mean, the you know what hits the fan, big time blowups. So one type of a hedge fund blowup is the hedge fund manager got all their investments wrong. Or let's put it another way. They had 26 investments, A through Z, and they got 18 wrong, 20 wrong. And I say never, it's rare. I mean, there's been tens of thousands of hedge funds. I'm sure there are some hedge fund managers who got it all wrong. It's rare. Most people are not that stupid. Bullet point number two is really where it is almost, if not always. It's the same stupid stuff. So hopefully at Wharton, at some point along the way, you learn from Wharton or your parents or your internship or your summer job. Don't be too concentrated in a very few positions. Basic stuff. You could, a 10-year-old could understand it. Or don't be too concentrated in just a few sectors. Or don't use too much leverage where you borrow money to increase your returns. Because, leverage is the classic double-edged sword. If you invest $1 and then borrow $1, so now you invest $2, when you're profitable, you make a lot more money. When you're down a month or a year, you lose more money. So very basic stuff. Or not having stop losses so that if a trade goes against you, there's never a stop and you can lose a fortune. And as they say in italics on this slide, it's almost always all or most of the above. So I hope that everybody still remembers Bear Stearns and Lehman Brothers. If you were trading stocks in 2007 and you bet that Bear Stearns and Lehman Brothers were going to go out of business, well, the first thing that would happen is you would be committed for being certifiably insane. Bear Stearns and Lehman Brothers were two of the most powerful, wealthiest, oldest firms on Wall Street. And if you told your friend, your parents, your dog, your cat that Bear Stearns or Lehman were going to be out of business, they'd have you locked up as being certifiably insane. But if you somehow managed to get your broker to buy deep out of the money puts on Bear or Lehman or credit default swaps or anything like that, where you would make a fortune if Bear or Lehman stock went down a lot, you would have made $1 billion and would be retired in the south of France. Or similarly, long-term capital management. Long-term capital was the smartest people. I was going to say, on the slide it says, read When Genius Failed. It's about how a Nobel Prize winner could make basic dumb mistakes. So in the case of Bear Stearns, Lehman Brothers, and long-term capital, they did not blow up and go out of business because they were wrong about a lot of things in their diversified portfolio. They went under and blew up because in the case of Bear and Lehman, they were very long, subprime, and very levered. And when you're very long and very concentrated and not diversified and very levered, it only takes a little bit for a firm or a company to blow up. I think long-term capital was levered about 10 or 15 to 1. And I often say it's like, riding a motorcycle. If you are riding a motorcycle on a gorgeous country road, 40 miles an hour, and there's a pebble in the road or a hole in the road, most pebbles or rocks you can go over. If there's a pothole, you can go around it. If you're riding the motorcycle 60 miles an hour, the rocks you can go over without wiping out, it's a bit more tricky. The same rock that you could go over at 40, you might wipe out at 60. And the same thing with the pothole. The same, when it's 60 miles an hour, you might not make it around the pothole or over the pothole. And you get the analogy. When you're concentrated and levered, it's like you're riding the motorcycle 120 miles an hour on the country road. The size of the rock or the pothole that can wipe you out can be very small. So that's what happened with Bear, Lehman, and long-term capital. Read When Genius Failed, because the lessons keep coming up. It's the same thing. It's business history. 99% of the time, it is the same thing. Maybe a different facade, a different icing on the cake, but the cake is the same. I'll say one thing about hedge fund frauds, or a couple of things about hedge fund frauds. Kind of like the blow-ups, I say highly sophisticated frauds are rare. You rarely have hedge fund frauds, kind of like Tom Cruise in Mission Impossible, with extremely complicated, movie-like, elaborate, convoluted fraud. It's typically most of them, almost all of them, are basic stuff. So everyone knows the greatest fraud of all time was Bernie Madoff. By the way, small fun fact: I actually grew up with Bernie's kids. We lived about a quarter mile away. Grew up with Bernie's kids, Bernie, Mark, Ruth, and Andy. It was a $65 billion Ponzi scheme. And Bernie Madoff was self-administering. Well, what does that mean? Well, a dozen or so slides beforehand, we talked about how every hedge fund has an administrator who verifies the returns, who works with the broker, who works with the hedge fund, who prints the investor statements. Bernie Madoff self-administered. What that meant is he did it himself, and his company did it himself. So, most hedge funds, including all of our hedge funds, we don't tell you how we did in January, February, March, and April. Our administrator tells you. I mean, yes, we will tell you too, but the official statements come from an administrator. We have auditors. Well, Bernie Madoff was printing his own statements. So you had to believe Bernie Madoff. $65 billion Ponzi scheme. Interestingly, when certain people were trying to understand what Bernie Madoff did, they asked him, we want to verify certain balances and speak to certain counterparties, the banks where you've got the money, the people doing the trading. And Bernie Madoff said no. And that's the biggest red flag of all, because almost all the frauds, if you check with third parties, and we'll get into that in a second, you can detect the fraud. But it was Bernie Madoff. Nobody challenged him, former head of NASDAQ. It was Bernie Madoff, and people, took him on his word. You should actually Google or ask ChatGPT about Harry Markopolos. It's fascinating. Harry Markopolos wrote, I think it was roughly a 15 or 17-page letter to the SEC, explaining in gory detail in more than a dozen-page letter how and why what Bernie Madoff said he was doing was impossible. That the returns that Bernie Madoff said he was getting, given what he was trading, were either impossible or beyond believable. So a few people caught it, but he was self-administering. So never invest in a hedge fund that tells you what their returns are, and very few do it these days. I mean, I don't think you could even get to first base with investors if you're self-administering. Those days are long gone. So I'll say a few more things about fraud, and we'll move on to other topics. So Madoff was a $65 billion Ponzi scheme. Pedders was only, and I'll put that in air quotes, only a $3.65 billion Ponzi scheme. Pedders were fake orders. He was doing factoring of receivables, where basically the hedge fund was loaning money to entities that had receivables coming in. What could go wrong? They've got receivables, they're coming in, there's no risk. Well, what could go wrong is that while some of that may have been legit, Hedge was faking orders from companies in some small or large part. And again, if you're doing due diligence on Pedders, give us the names of the counterparties, give us the names of the lawyers. And Pedders, I think, came back and said it was confidential, and huge red flag. There's no reason why you can't call up somebody and get confirmation. Maybe the names of the parties are confidential. Maybe the terms of the factoring are confidential, but you get the picture. If Pedders is saying he's got $3.65 billion of orders with umpteen companies, there's no reason why you should not be able to call and verify with a big law firm or a big accounting firm, is this legit? Maybe you ask Pedders for the list and it says investments, 1 through 100 without the names, but it lists something about them. There should be a way of getting that verified. Investors didn't. It was a $3.65 billion Ponzi scheme. Similarly, I'll mention Rothstein. Again, in air quotes, that was only a $1.2 billion scheme involving fake legal settlements. What could possibly go wrong? There were legal settlements where billions of dollars were coming in. The hedge fund invested in them. There's minimal risk because all these settlements are coming in. Most or a large number of them were made up. Again, if they checked with the lawyers, if they were allowed to, that wouldn't have happened. And the last thing I'll mention is unsupported valuations, so-called level 3 assets. If hedge funds typically trade so-called level 1 assets, they're on an exchange. If a hedge fund owns 10,000 shares of Apple or IBM, We all know what that's worth. It's on the exchange, it's traded. That's level one. Level two can be more over the counter where they get a number of broker quotes, and you can still get a pretty good idea. Level three assets are where they're not in an exchange, they're not traded by brokers, you can't get quotes, and the manager typically has to give what is hopefully a fair valuation. And the moral is, if they're level three assets, nothing wrong with it, but the manager should be getting someone doing independent valuations of level three assets. And there are companies that do this for a living, and they will vouch that the manager's valuation of those assets is in line with reality. So as I say in italics on the slide, virtually all frauds are easily detectable if investors had just checked with independent third parties. A lot of the questions, not surprisingly, at Wharton end up about jobs in hedge funds, how to get them, how to keep them, et cetera, et cetera. So I'll say a few words on this as well. So how to get a job in hedge funds. I mentioned in parentheses, LinkedIn and recruiters are great, but typically when you have more experience is when LinkedIn and recruiters get involved. But LinkedIn does have some junior jobs as well. Recruiters tend to be more high level, but LinkedIn does have some, but typically they're for people who have some experience. But I do mention some resources here. Alborn Village is a great resource. It is free hedge fund news. They also have some job listings. LinkedIn, as I said, ton of hedge fund jobs. You can set up alerts, although typically for folks who have more experience in the field. Recruiters, again, typically for more experience, you can Google hedge fund recruiters, but I do name about a half dozen who do a lot of hedge fund recruiting. As I say on the slide, a great pro tip, this is one where most people never think about it. You can do an advanced search on LinkedIn for senior people at hedge funds who both, number one, work in hedge funds and also went to your college too. So you can do searches for people who are senior at hedge funds and who went to Wharton. And you'll find a lot of them, but no reason why you can't reach out to them. Most people will try to do what they can. And the last bullet point that most people under a certain age typically have no idea about are, like every other industry, no matter what you do, whether you make widgets, whatever it is that you do, there are trade organizations. Join them, and as importantly, attend and network, and eventually seek a leadership position when you've been there for, pick your number of years, 5, 6, 7 years perhaps. And I give a half dozen or more of the alphabet soup, as we call it, in the footnote there. You can join them all. They publish news, they publish white papers, they have events. For a lot of people who ask, how do I learn about hedge funds? This is another great resource. I also want to mention a couple of things about how to keep a job in hedge funds or any job. Some people ask questions about this, what to do after you've landed the job. So a half dozen bullet points, I'll speak to you a little bit. Some of this may seem obvious, but you'd be shocked how sometimes people don't get it, which is why they're on the slide. The first one, do exceptional quality work. I say, obviously, that needs no commentary. Obviously, that's number one. Number two, maybe brainstorm and find and do additional projects you were not assigned. If you think of something that is interesting and could be of value to the company or the fund, ask if you can do it. Obviously, it goes without saying, get permission first. And obviously, make sure you've got the time and the bandwidth and approval to do it. But if you can think of something great that could help, take the initiative, even if you weren't assigned it. Number three, another thing a lot of people don't appreciate, if you can be a revenue generator, no matter what your job is, lawyer, hedge fund person, if you can be a revenue generator, terrific. If you're a lawyer and you can bring in millions or tens of millions of dollars of business, I say it slightly exaggerating, your law firm's not going to care if you spend all day on the golf course or all day at the beach. If you can bring in tens of millions of dollars of business, they'll be very accommodating to everything else about you. It goes a long way. Similarly, in the hedge fund industry or private equity or venture capital, if you can help the firm make a lot more money, that's the best job security you could ever have, because why would they lay off someone who's making them a lot of money? And that can be several things. It can be obviously bringing in big investors, number one. It can also be alpha, returns. If you're a genius who can help figure out how to make an extra couple hundred basis points a year on the investment side, you're the last one they're going to let go. In fact, they'll probably never let you go because they'll make more money with you than without you. Also, too, if you're the only genius at your hedge fund who actually understands certain things about the quant models or about, the regulatory for the in-house lawyer, it's sort of as I told younger people, you can make a lot of money if you're the only person who knows how to figure out X, Y, or Z, and it's valuable. So, brain surgery, very difficult brain surgery, very important. You'll probably do well, at least financially, if you're a brain surgeon. If you can figure out the value of stocks, you'll do very well if you can do that as well. Or similarly, at a lot of law firms, the tax partner, he or she is often one of the most highly billed out partners at the law firm because it is incredibly complex, the tax code, and incredibly important to deal. So if you can be the great trader, the great investment fundraiser, or the tax partner, you'll probably do well. The fourth bullet point's important as well. At every job you will ever have, there's going to be some annoying part of the job. The expense reports, the timesheets, closing out budgets, not the most sexy, glamorous, or fun thing. Please take it seriously. Do it well, do it on time. Don't be the person who your boss has to constantly chase for that stuff. Because I have managed a lot of people. My wife has managed a lot of people. My friends have managed a lot of people. You don't want to be the person who is the annoying one, who does a good job at most of the job, but then doesn't get some of these other things done on time, their expense reports, the timesheets, the budgets closed out. You don't want to be that person. Or as I say in the penultimate bullet point, attitude, the PIA people, you probably know what PIA stands for. If not, Google it. Often are the ones who get laid off first. It's simply, you don't want to deal with them. Or as I say in the last bullet point, don't be the dinner table conversation for your boss when he or she is complaining to their spouse about the person at work who just doesn't get things done on time or doesn't get in the timesheet or doesn't do the expense report. So it may seem obvious, but don't be that person. I also want to throw in here because I'm speaking at Wharton about a few random, as I call them, random but critical life lessons. Some of these are probably going to be the most important things I've said. If so, send me an email, 2, 3, 5, 10 years later, and let me know. Random life lessons. One thing, when it comes to networking, take notes on business cards. I have been to over 1,000 industry events and hedge fund events and investor events. And if you go to a big industry event and you meet 100 people or 50 people or 75 people, and you do not take notes on business cards, the next day, unless you can memorize the phone book, and I can't, unless you can memorize the phone book, you're going to have no idea at all which ones were the ones you had to follow up with, what you spoke about. So you don't need to write, the Encyclopedia Britannica on a business card. A couple of words. I always put a star or 2 stars if they were important to follow up with. So the next day, if I've got 50 business cards, I just look for the ones that have 1 or 2 stars. I have a couple of notes I know we spoke about. Take notes on business cards. I've been told by a lot of people, I never thought about that. It's brilliant. Maybe yes, maybe no, but otherwise, what's the point of going to the event if you can't follow up with the ones that are the most critical to follow up with? Second bullet point I mentioned, get a mentor. If you can ask an industry leader for 15 minutes a month, maybe one who went to your school, they'll probably do it. Maybe it's 15 minutes every other month, whatever it is. Most people will do it. Get a mentor. They can be invaluable connections. How do I manage this problem? How do I handle this? What do you think about it? Most people are very gracious. Everybody was younger once. They're typically, if you keep the ask 15 minutes a month, it's hard to say no. Bullet point number 4, diversify stock in your company, explain. For those who go into private equity or venture, if you ever build a successful company and God willing, it does well, and you've got millions or tens or hundreds of millions of dollars of stock in your own company, please, please, please sell half of it. I have seen people, and you know where I'm going with this, who end up with 99% of their wealth in one company that they formed. Things can go wrong with your company, with the industry, with regulators, with a recession, with a pandemic. Please, please, please. If you ever have 99% of your money in your own company, sell half of it. 5 years later, either one of two things are going to happen. The company has some issues and challenges, and you call me or email me and thank me because you took half your chips off the table. Or you call me or email me and say the company did great and you only made hundreds of millions and you could have made more, but you can't have your cake and eat it too. So to put it another way, you would never in a million years right now take 99% of your money or your parents' money or your dog's money or your kids' money or your company's money or Wharton's money and put it in one stock. You would never physically take 99% of anyone's assets and put them in one company for obvious reasons. But if you own a company and your company's done well, you may have 99% of your assets in that company from the back door, so to speak. It's a recipe for disaster. It takes the money off the table. I know so many people who didn't. I might have just saved you 10 or $100 million. Send me 20% if I did 10 or 15 years from now. And the last bullet point I mentioned, on a more personal note, you may be far from thinking about dating, marriage, and kids, but I say enjoy Philly, enjoy New York City, wherever you end up, but don't get too caught up in what I call the scene. Life can quickly pass you by. Have fun, enjoy it. You're only young once, but don't get too caught up for too long. Life could pass you by. I'll leave it at that. I'm now going to get to all the questions you sent in. This is my QR code. Yes, that's a picture of me in the middle. If you have any follow-up advice or questions, you can snap the QR code. The PowerPoint will be circulated. Please email me next week, not this week. And as I say, if you don't hear from me after 2 weeks, please follow up. I literally get hundreds of emails a day and thousands a week, and I'm working 80-hour weeks on top of it. So, this is not like dating where someone doesn't get back to you a couple of times. They're not interested. This is not like dating. People are busy. Investors are busy. I've raised more money from more investors who didn't get back to me the first time I reached out. They're swamped. I'm swamped. Give it a couple of weeks. I try to get back to everybody, but here's the QR code. So let me get into the Wharton Q&A. The questions were great. Thank you very much. If we have time at the end for more, if we do, we'll take some, but we've got so many. Let me try to get through them now. First question, how would you recommend breaking into the industry for someone from a quant background, not from a business background? Interesting question. The 4 answers I gave, obviously try to learn as much as you can about hedge funds in general and about quant in particular. A bunch of the resources I gave before, they publish daily, weekly, monthly. Read as much as you can. I mean, to a point, obviously, about hedge funds and quant. Get up to speed. Secondly, if you're going into quant, I assume you probably want to learn to become proficient at the most common hedge fund quant programming languages, things like C++, Java, MATLAB, Python. I know some people here already know some of these things, but if you're going into quant, those are the lingua franca, or the 4 main languages. There's others as well. Third point, obviously network extensively, like any situation, and get a hedge fund internship and mentor, same as I said before. Question 2, what are the trends in hedge funds and private equity? Hedge funds, and I got a lot of questions about this. We'll get into it more later too. The ever-increasing amount of quant and AI. It is just mind-boggling. I'm now asking ChatGPT 20 questions a day about a ton of things. And people love to make fun of when ChatGPT is wrong. But I like to say 90% of the time, ChatGPT is 100% spot on right. 5%, it gives you enough information where you ask a follow-up or two, et cetera, et cetera. And 5%, it's dead wrong, but usually you know. So everybody made fun of ChatGPT when it said in some context, I don't know how, someone had killed their kids when they hadn't. Okay, it's funny, it makes the press. No one took it seriously. 90% of the time, it is 100% right. It's incredible. And like I say, if you had a stock that goes up 90% of days, that's a great stock. So the ever-increasing use of quant and AI, it is mind-boggling how much it is helping hedge funds trying to figure out new insights into companies, into sectors, into investing. Obviously, not every quant hedge fund is going to do well. Not every AI hedge fund is going to do well. But I don't think you can be taken seriously if you're not looking at least at some degree of quant and AI and data and alternative data these days. We've come a long way from totally fundamental with minimal data. I think those days are gone. On the private equity side, as some people have asked, the continued growth of private credit and the ever-increasing expansion into new fields and niches. For example, I recently met a phenomenal fund on the private equity, private credit space that does financing for social media influencers. Phenomenal fund, great team. They know the industry, they know the space, they know the best social influencers, the best YouTubers, and they know exactly how to pick the best of breed for the ones that are going to get to the next level and that are already successful and already profitable, but that are going to go from first base to home or second base to home, pick your metaphor. So the ever increasing amount of AI in hedge funds and an ever increasing amount of private equity and quant. Question three, advances in LLMs and AI, the effect on how funds are approaching investing and research. We've touched on this a little bit, but I actually happen to work in AI for many years, and the advances in LLMs are staggering. Funds are using both off-the-shelf products like ChatGPT and Grok and Perplexity and Claude, and also some custom AI where they're building their own AI engines that focus on particular areas. Because obviously, like anything else, everybody's a specialist. And if you build a specialist AI that's an expert on X, Y, and Z, it'll probably do better than ChatGPT, which has to be an expert to some degree on everything. And then they're just turning them loose and seeing what they can find. Most funds I've seen are still having human oversight to try to figure out if what the AI recommends makes sense, but we'll see how that goes in the future. Question four, how does a typical LP presentation go? What aspects of your fund are most important for LPs? Well, the presentation, point A is one of the less obvious things that most managers don't do. I always do it. It's invaluable. Most managers don't. Most managers or fundraisers launch into, hey, let's tell you about our fund. Not quite in those words, but that's what they do. Big, big mistake. The first thing at meetings with investors, and I've done hundreds, whether it's in person or Zoom, what have you, is always ask the investor for an update on their end. What's new with their investment program and their foundation, their pension? In general, what's new with their hedge fund or private equity or venture capital allocation program? It's invaluable because you will learn a lot more about what they're doing, what they're looking for. And look, at the end of the day, if they're looking for apples and you're oranges, then maybe it's not a fit. But oftentimes you can truthfully and accurately pitch your fund better if you know what they're looking for, because, oh, yeah, we do that. And what they're looking to avoid, oh, we don't do that. So always start off with asking for the investors a bit of an update on what they're doing, what they're looking for. It's a lot better than just launching into why your fund is great. Here's our wire instructions and please send us money. That's the first thing. The second thing, of course, is the fund introduction, the 10,000-foot view about the fund, the team, et cetera. Then, of course, is the fund, detailed presentation followed by a Q&A. And of course, it should be somewhat interactive during the presentation. It's pretty much what you would expect, except the first part most people forget and most fundraisers forget, or they just never knew you should ask in the first place. What's important for LPs, it's an interesting. I get hundreds of requests a year from everybody who wants me to raise them the first billion, the second billion. And they often ask me what's important for investors. And, what am I supposed to say? Bad team, bad track record? Well, no, of course not. I mean, good team, good track record, great team, great track record. Obviously, once you've been in the industry for a while, the infrastructure's got to be there. The service providers have to be there. I mean, if you've got a no-name auditor, just pack it up right then and there. Don't even bother. It doesn't have to be one of the big four, but the track record, the management team, infrastructure, service providers, risk controls, everything we've covered in the first several dozen slides. Question five, how did I know I'd be able to excel at fundraising? Great question. I had no idea. I did not grow up at the kitchen table saying, Mommy, Daddy, I want to be a hedge fund fundraiser. Did not at all. Happened to luck into it. Totally fell into it. I had a bunch of friends that ran operating companies and some friends who ran hedge funds. And it was complete accident and total dumb luck that I discovered that I was really good at fundraising. I think it was a couple of things. One, understanding the investment product. I mean, the better you understand what you're selling and raising money for, the better you'll do. So that's critical. A lot of fundraisers are kind of smile and dial and spray and pray. You don't need to know it as well as the PMs, but if the PMs know what they're doing 100% and the senior team knows what they're doing 95%, and the junior people know at 85%, don't start trying to pick up the phone and call your investors and raise a couple of $1 billion until you know it 75 or 80%. You only have one chance to make a good impression. Know what you're selling very well, know what you're raising capital for. So that's one thing I think I do very differently. I really try to dig in and learn the strategy and the process and the people. And so before I start picking up the phone, I'll invest a week or two in really seeing what they're doing because everybody does it a bit differently. There are thousands of long short equity funds, and everyone does 80% the same, but the 20% they do different. Everyone makes the stew a bit differently or makes the sausage a bit differently. Pick your metaphor. Know what you're doing at your firm before you try to raise money. I think other reason I was good at raising money is I just knew a lot of investors and then made a point of getting to learn more. I've been to 1,000 hedge fund and investor events, but it honestly was just dumb luck that I kind of discovered. I knew a lot of investors and I knew a lot about finance. And maybe one thing is I was pretty good at doing what Albert Einstein famously said. Albert Einstein famously said, I think it's a direct quote, make everything as simple as possible, but no simpler. So and we'll get into this later. I've gotten emails pitching me about funds, and sometimes the emails are very short. They don't say enough. I don't have the time. Investors don't have the time to read through 100 pages of your attachments. That email's got to give a pretty good idea of what the fund is doing and why they're compelling. Conversely, I've gotten emails that go on for 10 pages. No one's going to read that either. So trying to find that Goldilocks sweet spot of the elevator pitch. Do you understand, if you're going to be a great fundraiser, understand the product, understand the team, and be able to give the 45-second or 5-minute pitch or both under the circumstances in terms of what you do. But it was pure dumb luck. I had no idea growing up I'd be, great fundraisers, pure dumb luck. Question 6, how do you convince large institutional investors to invest millions of dollars of their capital? As I say in the answer, you do not, in air quotes or actual quotes, convince investors to do anything, not in a million years, especially to invest 50, 100, or $250 million. Rather, you just got to build a very high quality fund, a great team and track record, and implement best practices. And of course, also hire a great top fundraiser. And it's not just me, there are other ones in the business you can hire. But I once had a PM say, well, couldn't I raise $1 billion, Evan, on my own and just skip hiring you? And I said, well, you could, but I probably know 50 times or 100 times the number of investors you do. And it took me 20 years to get here. So, why would you want to spend 15 or 20 years? Just hire someone who already knows the people. So you can't convince investors of anything. Build a quality product, be respectful, be polite, and hire a great fundraiser. Number 7, the most interesting unintuitive trend in the markets that I've noticed recently. Hard to say, but I'll give 2 examples. I think recently, the very harsh and stark reminder that investors hate the markets, the recent sort of tariff du jour and a lot of flip-flopping on tariffs. As you all know, that caused a lot of downturn in the markets. Investors like certainty. There's never 100% certainty, but that was a very harsh reminder that if people do not have confidence in relatively steady seas and calm winds, that a lot of them will bail. That was one. And the second thing is sort of the opposite. It's government supporting cryptocurrency. This has been pretty extraordinary. The Trump administration, the new administration, has been plainly pro-crypto. Many candidates running for office increasingly are pro-cryptocurrency. And I'm not, underscore not 100 times, saying you should buy Bitcoin and pray that it goes up. That is not an investment strategy. That is speculating and gambling. But there are an increasing number of sophisticated long-short hedge funds that are long-short cryptocurrency, applying rigorous fundamental and technical and quant analysis to the leading liquid cryptocurrencies. And if you look at the regulators of the industry, the changes with the new administration are very clear. The administration's pro-crypto, the regulators they put in are pro-crypto. So we were in a brave new world. Those are 2 recent changes I've seen. Question 8, the biggest takeaway from all your years in the hedge fund space. I mean, this is tough, but I think risk is critical. Everything else, how to make money, be diversified, be smart, pick good stocks, to some degree is obvious. Obviously, the devil's in the details, but risk is critical. The there's no reason why Bear Stearns and Lehman Brothers should have gone under or long-term capital should have gone under. It's probably the number one takeaway. Question 9, how does your background in law support your current role? Well, perhaps obviously, maybe not. It helps me to understand better hedge fund compliance, hedge fund law, hedge fund regulation. But as they say here with the underlining, please do not even think of going to law school, which is 3 years, unless you're going to go to practice law full time. Do not. If law school were 1 year, we could debate that. It's 3 years, the opportunity cost, the out-of-pocket cost. Don't spend a small fortune and lose 3 years of income just to learn hedge fund law. There are plenty of places that I could refer you to where you can learn enough hedge fund law on your own if you think you need to know hedge fund law. But so unless you're going to be a full-time lawyer, do not even think of going to law school. It's sort of like I have some friends who went into the family real estate business, and my family has been involved in real estate for generations as well. And they say they went to law school to learn real estate law. And I said, wait, you're thinking you're going to law school for 3 years of your life to learn real estate law? I can send you to classes where you'll spend 3 months learning real estate law instead of 3 years. So it's helped me, but only go to law school if you want to be a lawyer. I think enough said with that. Question 10, the most important skill you look for in hedge fund and private equity job candidates. Fair question. Obviously, the first point, are they smart? Obviously, goes without saying. Smart, articulate, have they accomplished a lot? Has this person maybe created things and taken the initiative? Do they have some personality, but not too much? Do they have some humility and maturity? In other words, net, 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 net. Is this someone who will do a great job and not be a pain in the ass, a PIA? That says it all there. Is this someone who's going to do a great job but not drive people crazy? And that's basically it. I put in parentheses for one of the things, HLS, for someone who created things and took the initiative. At Harvard Law School, someone asked me once about Harvard Law School, what the people were like. I said they were totally normal, socially, academically, very smart, totally normal. There was one thing I noticed that was very different. Instead of a lot of people who wrote for the college paper, or who were on this team or that team, or worked at some company, a lot of people at HLS were the ones who started the college paper, the new college paper, or who started companies, that type of thing. So, people who created things, not required, but, all these things are good. Just someone who's going to do the job, show up, has some personality, but is not going to drive people crazy because they've got the biggest ego of all time. What lessons from Wharton have been the most applicable in your career in finance? Honestly, most of what I studied at Wharton, economics and finance, were the fundamental building blocks of investing. But in terms of career advice, question 11 is asking about career advice. That's been on-the-job training and a lot of stuff I've discussed here. It's sort of like when you take driver's ed for however many months in high school, and then you start going out with the instructor on the road. There's the lessons you learn in driver's ed, but until you start taking the car on the road, it's very different. And same thing here. What I learned at Wharton was invaluable, learned a ton about a lot of things. But in terms of career stuff, a lot of it was sort of on the job training. Question 12, best skills you learned in the industry. This one gets its own slide because there's more than a half dozen of them. I'll read them. This is it. A, work hard, do an excellent job. Again, obviously. B is a bit more subtle. In college at Wharton, you can do the A+ job because you're taking 4, 5, or 6 classes. There's some limit on how many classes you're taking, so you can theoretically do the A+ job. When you get to the so-called real world, the business world, the corporate world, the hedge fund world, do the A- job because the A+ job will take you twice as long and take double the time. And the truth is, the A- job is 99% as good as the A+ job. So if you can get double the amount of 99% successful work, you end up doing a lot more value than if you do 100% of 100% successful work. Do the A- job. You get a lot more done. C, if you're going to be late with something, and it will happen, tell people in advance. Seems obvious. You'd be surprised. D, I mentioned, take the initiative if you can help. Not just your job. If you can find something else helpful, pick it up and run with it. Take the ball and run with it. E, I mentioned a bit before, always do on time the grunt part of your job. That's not the fun part. Don't be the person who's got to be chased down because he or she doesn't do, the non-sexy grunt work. F, network extensively, publish, speak publicly at a certain point when you've learned enough that you can do so credibly. G, always carry business cards, not just the QR code. There's an exclamation point there. So why am I up on my soapbox about carrying business cards? Well, first, your business card should have a QR code on the back, but why not just a QR code with the two phones and the scanning and the swiping and all that, virtual stuff? Very, very simple reason. If I or you or we go to an event, an investor event, a hedge fund event, and we meet 100 people, we take notes on cards, the next day we can go through the cards and take notes that we took notes on and know with whom to follow up. We have an action plan. If it's just all this QR code stuff, you'll have no idea the next day who was that person whose QR code I swiped if you don't also get a business card. There's no way of reverse sorting your contacts, I believe. Who have I met in the last 24 hours? So if someone doesn't have a business card, which they should, swipe the QR code, but also take a screenshot of the QR code. So in your pictures, in your photos, you can go back the next day. Oh, yeah, I met Billy, I met Susie, and politely ask, can I take a picture of your badge, your name badge? Everyone says yes, of course. So in your photos are the people who didn't have the business card. It's invaluable. Otherwise, you'll never remember the half dozen people who didn't have the business cards. And then lastly, and this may seem incredibly obvious, always carve out and set aside time to follow up. You'd be shocked how many people go to the hedge fund event, the investor event. They register. Maybe they pay money. They travel to the event. They spend time there. They take notes on the business cards, and they don't follow up. Woody Allen, if you can still quote Woody Allen in one of his movies, said 90% is showing up. 90% is showing up and following up. There have been times where I've met a bunch of people where I could help them. They could not help me. I could help them get a job. They were looking for a great hedge fund I knew. They were looking for great investors who I knew. So it was going to be a one-way street. The percentage of people I meet at events where I can help them alone, who follow up with me, about 25%. 75% don't ever follow up. It's shocking. So it's not always easy. You've got a job, you're busy, we're all busy, but you got to carve out time to follow up the people you met at the hedge fund event, at the investor event, because if you don't, you wasted your time and your money going. Question 13, do I think that the strong flow of LP dollars towards private credit will continue? The answer is yes. I think that private credit has become the new normal. It is increasing and ever increasing. And the answer, why? Two reasons. One, private credit creativity. They can go anywhere, do anything. I mentioned before the social media expansion capital fund. Brilliant. It's a niche opportunity, brilliant. And also more bank regulations. There's been more and more bank regulations. So the hedge funds have been coming in and the private credit and the private equity funds because there's more opportunities in private credit and also because there's more bank regulations. So the banks are doing less and less of it. So the answer is yes. Private credit is here to stay. It is not a fad. Key factors in identifying successful PMs, question 14, easy. Simply look up the funds that Benoni and I work with. That's it. Very simple. Okay, joke aside. In addition to that, also, their track record, obviously. It's not the only thing, but if a manager's lost money every year, I don't care how good, investors don't care how good the infrastructure is. They don't care how good the service providers are. Of course not. So good team, good track record. A lot of times investors will speak to the former and current peers about the portfolio manager. They say it's a small street. There's probably 10,000, 12,000 hedge funds and 100,000 people in the industry. My email list has got 160,000 people on it in this industry. Roughly half of who are investors, endowments, foundations, fund of funds. It's a big industry, but it's a small industry. And so, investors, allocators will call up people they know who used to work with the PM or still work with the PM, and they'll ask about Billy or Susie, the portfolio manager. So, they do their homework. And one of the big questions is, how did they navigate the difficult markets? Have they been through, 2008 and 2009? How did they navigate those? How did they do in the COVID crisis in March of 2020? Those type of things. So, the lawyers and the documents always say that past performance is not a guarantee of future returns. It's not a guarantee, but it's usually a good indication. As I like to say, If there's a baseball player and he or she has batted 300 or 350 for 10 years, there's a pretty good chance that that baseball player is going to bat pretty well next year too. Versus if they batted 200 or 250, it's not a guarantee, but it's indication. So track record, speak to their former colleagues, and see how they navigated in the difficult markets. Question 15, the increase in retail trading, how's that affected things? I'll give two examples of this because retail trading has gone through the roof. There's Robinhood, there's apps. A lot of people, billions of people who've got smartphones, and you can trade on your phone for better or for worse. And most times it's probably worse. I've often said, if you need surgery, God forbid, you don't do your own surgery. You're smart enough to know that you didn't go to medical school, don't do your own surgery. But everybody thinks they're an expert stock trader. Now, maybe you went to Wharton, everybody here goes to Wharton, so you probably know more than the average bear when it comes to stocks and investing. But so the two examples I give are meme stocks. This insane thing, you may have heard about it. If not, definitely Google it or ChatGPT it. The meme stock phenomenon, where a ton of retail traders got behind a bunch of hedge fund stocks that were probably shorts, and that a lot of hedge funds were shorting. They got behind them. They caused this frenetic situation. The price of these stocks went up. The funds that were short them had to cover their shorts or had margin calls and ended up having losses. Stick to rational markets. At this point, a lot of hedge funds are not shorting anything that involves crazy meme stocks where millions of people are trading it on Robinhood or some other platform. The second thing is cryptocurrency. This has a massive retail space of a lot of retail people speculating and trading on cryptocurrency, just like meme stocks. And this has created an opportunity for some experienced hedge funds with people in their 40s, 50s, and 60s who've come from major firms, from Goldman, from Morgan, from Citi, from JP, or big hedge funds, Izzy, Stevie, Brevin Howard, the big funds, to put together highly experienced funds that are not buying Bitcoin and praying that go up, like I said before, but they're running sophisticated fundamental research and quant funds in cryptocurrency and taking advantage of the fact that there's a lot of inexperienced retail money. And like I say in parentheses, the best metaphor, and I'm a recovering lawyer, we love to make metaphors and analogies. It's like the varsity team playing in the freshman league. If you're highly experienced veteran hedge fund people in the crypto space, you're not going to be up every day. Only Bernie Madoff was up every day. But you're really the varsity team in the freshman league, or to put another way, you're the professional poker player playing in the amateur league. So those are two things that I've seen have an effect, retail trading, the meme stocks and cryptocurrency. Question 16, what are the most important factors to success in the industry apart from your connections? I think it's just sort of what it boils down to is your experience, your expertise and skills, especially if they're unique or compelling, the network you have, and the ability to grow firm revenues and profits. If you can bring in alpha and increase returns, if you can bring in investors, it's very simple. Close your eyes and put yourself in the boss's shoes or the shoes of the head of the firm or the head of HR, depending upon the situation. If they've ever got to let people go and things happen, there's risk, reduction in force, there's recessions, it happens. How can you be the person in the top 10, 20, 30% where they're not letting you go unless hell freezes over because you're helping to increase returns, you're helping to bring in investors. You've got great experience, you've got great skill. If you're the only person who knows how these three valuable systems work, you get the picture. If you're all or most of those, that's the best career, the best career advice, the best job security you could ever have. Question 17, the one piece of advice to give to a freshman just starting off with all of this stuff. Well, and I underline this, the first thing is take a wide variety of classes because, look, I love hedge funds. I love alternatives. I've been doing it for 20 years. I love alts. I eat, live, and breathe this stuff. But in fairness, if you're a freshman, take a bunch of classes. You might discover you like something else more. I mean, that's the one piece of advice I always give freshmen in college. Unless you're pre-med where you've got to do A, B, and C because you're pre-med, take a wide variety of stuff, because unless you went to some strange high school that really had everything under the sun, which most high schools don't, your college is going to have things that you never had in high school. So, before you decide what your favorite flavor of ice cream is in the ice cream store, go to the store, sample a couple of dozen ice creams, try a bit of everything and see which one. And if it's hedge funds, terrific, but you might discover you like something else more. But, just to hedge your bets, hedge fund, pun intended, of course, while you're experiencing everything else and trying everything else, read a lot about hedge funds in the news and the periodicals I mentioned before. Join in and participate in industry associations. There is, for example, if you go to Wharton in Philadelphia, there is a Mid-Atlantic Hedge Fund Association. Join and go. I don't think they've got age requirements, and if you're underage, you just can't have cocktails at the bar. Join and go. Read the publications. Read all the law firms that publish on hedge funds. Try to get an internship at a hedge fund, and again, try to get a great mentor who he or she will give you 15 minutes a month. But try everything else, because you might decide you like something else more. And that's, at the end of the day, nothing wrong with that either. Wrapping up with a few last questions, and I'll take some if we have time. Question 18, the most pivotal moment in your career that's shaped your investment philosophy. This is a 3 beer or 3 cup of coffee story, but I would say experiencing and living through the Great Recession of 2008 and 9, and then the March 2020 COVID meltdown. Like I said, ask PMs how they dealt with that, because until you've been through that, that's the critical stuff. How does the pilot deal when they're piloting through a storm? Everything else is important as well, but that's some of the most critical things I learned, are living through a crisis, because there's an old expression, what is it, in wartime? All the best war plans end when the first shot is fired. So that's one of the things. Ask the PMs, how did it go? And ask your colleagues, how did they do? And how did they cope, during 2008 and 9 and the Great Recession and the 2020 COVID meltdown? Because there's a famous quote from Darwin: it's not the strongest that survive, it's the ones that adapt. So how did the PM and his or her fund adapt when those crazy events happen? Question 19, how do you like the trade-off between short-term performance and long-term investment strategy? Good question. I think the short answer is this. Institutional investors especially, and also most family offices too, they're allocating typically to funds and managers for the long term. And I say in the slide, Warren Buffett quote. Somebody asked Warren Buffett, the famous Warren Buffett, how long his investment horizon is. And he looked at them and said, forever. And that's basically true with most institutional investors. The colleges, the endowments, the pensions, the UPenn endowment, teachers of so-and-so, firemen of this, all the big pensions, they're investing forever. They're looking for managers who can put up great numbers most years, who have a reproducible edge, who communicate in good times, who especially communicate in bad times. They don't care if you've got a bad month, a bad quarter, or a bad year. Very few institutional investors and even family offices are going to pull out of your fund because you had a bad month, a bad quarter, or a bad year. They're looking to you for the long term, 5 years, 10 years, 20 years, 1,000 years, that type of thing. A few family offices might be different, a few fund of funds might be different, but to put it another way, serious investors are going to spend months doing due diligence on you and your hedge fund. They're not going to invest months doing due diligence to pull out because you had a bad quarter. So very few investors looking on the short term. That said, as the last sentence says, most, if not all, investors do have a maximum short-term drawdown. So, most investors have a certain tolerance. It's different for everybody, how big the biggest peak to trough drawdown can be. For some institutional investors, that's 10, 15, 20% under normal circumstances. For some family offices, it could be more. It depends on the asset class. It depends. But other than that, they're looking for the long term. Question 20, common mistakes you see new analysts and associates make at hedge funds and PE. A couple I'll mention. There's probably more. A, falling in love with a company, position, or a stock. Fall in love with your spouse. Don't fall in love with a company, a position, or a stock. You've got to be objective. and you've got to know when to cut your losses. You've got to be able to admit when you were wrong, or maybe you were right and the market's wrong. We'll get to this in a later question. There's an old expression. It's an old expression on Wall Street. You'll go broke before you're proven right. So don't fall in love with a company position for a stock. Fall in love with your spouse or your boyfriend or your girlfriend. Second one, not appreciating the critical need for risk controls. I think I mentioned risk 10,000 times already. That's important to know. No matter how senior or junior you are, that's important to know. Probably they've got someone more senior focusing on it, but you should know it too. Third, not knowing when to take profits when you do make a lot of money on trades. And I say in parentheses, skill plus art. That is just one where it's a lot of experience. When to take the chips off the table, when to take the profits, when to take most, when to take them all, when to let the trade go longer. That is probably 50% skill and 50% art and experience. And the last one I would say is kind of what I said before. When you're young, being totally adrift in the first bear market, if you're 2 or 3 years on the job and you've never been through a 2008 or 2009 or a March of 2020, it's tough. How can you possibly know how to deal with it when you've never been through it? Fortunately, you've got senior colleagues where it's their job because there's no way you could be the expert on that when you're 20 something years old.
Hey Evan, sorry to interrupt. Due
Sure.
to like time considerations, we probably could do one more question because it's 10 past 8:30 right now. So yeah, we
Okay.
probably could wrap it up with one last
I,
question.
I'm smiling and I appreciate it. No problem. They were great questions. I did include answers for all of them. So we'll take one more question, 21. There's 28 questions. The rest of the answers are in here. And I appreciate your interrupting me. Fair enough, in the interest of time. Totally get it. Our last question, number 21, the rest you can read offline. Given rising interest rates, how are you approaching your portfolio or investment approach? Great question. Significant interest rate changes, of course, affect things, but they make things easier for some hedge fund and PE funds and strategies and more difficult for others. So, like a lot of things, it depends on the fund. It depends on the strategy. Most of our funds and strategies are doing well, regardless of interest rates, but they definitely can take effect. So I will skip the next couple of questions, go to the conclusion. In the interest of time, you can read the answers offline, and I'll conclude in there. Well, more questions we don't have time for, but feel free to email me next week. If you do have any more questions about the presentation, please feel free to do so. And lastly, the last slide, of course, many thanks to Wharton. Many thanks to the folks who planned the event. I won't name them all. And many thanks, of course, to all of the event attendees. Would love to hear from everybody, not this week, spread it out a bit. And if I don't follow up, please give me a week or two. I do get thousands of emails a week, and I'll turn it back to you to do the outro, so to speak. But thanks to Wharton and all the event attendees. Thank you very much.
Thank you, Evan. I think on behalf of Wharton Hedge Fund Club, I think all of us here would like to thank Evan for taking time out of your busy schedule to come and speak to us. I think we all learned a lot about the hedge fund industry, overview, different strategies, and your valuable advice on navigating school life. And I think we'll definitely be very happy to distribute the slides and pass on your contact to the rest of the members, and for the members to also reach out to Evan as well. So thank you all for coming today and have a good weekend ahead.